Thank you everyone for joining me this afternoon. Options Play is a great tool that's designed to help you guys better understand options. I know options, learning how to trade options or trading them in general sometimes takes a lot of time to learn. So what we want to do is show you some of the new tools that are available that will help you either shorten that learning process for those of you that are brand new to options. And for those of you that are currently already trading options, we want to show you how you can very quickly find the strategies that you really want to trade without a lot of manual work. So that's really what we're going to spend a bit of time showing you guys here today. So before I get started on the actual tool, what I really want to talk about a little bit about is what the current experience for a lot of options traders is. You're using the option chain to find a different expiration and strike price regardless of what the strategy is. There's a lot of work involved in doing that. If you're brand new, a lot of times this page is a little intimidating. You don't necessarily know what's the best expiration to choose, what's the best strike price, and how do you do your analytics? What's the difference between trading this 175 and this 180 call? How do you analyze the two? Or how do you decide, should I buy a stock or should I buy a call? These are all the things that as an options trader, whether you're starting out or if you're an experienced options trader, these are all the problems that you continuously have day to day. So what I want to do is show you the tool that helps solve a lot of these things. So there's a tool called the Options Wizard, which you can access under the Options Trading tab, and you'll see this button here on the right that says Options Wizard. When you click on that, what it will introduce you to is this page that you see here on the right-hand side. This is the Options Play tool that's available to you free of charge through your Firstrade account. So I highly recommend, for those of you that are currently trading options, take a look at this because it's going to make your life a lot easier compared to using the chains, okay? So the platform itself, for those of you that have never seen it before, is divided into 3 sections. We have trade ideas and watch lists here on the left. We have our security analysis panel here in the middle, and then we have trading and income here on the right. Okay, these 3 panels, we call it the what, the why, and how. The reason for that is because every day when you come into your platform, you want to know what symbols should I take a look at. So we have fresh trade ideas that are sorted by bullish and bearish trade ideas every single day, and it allows you to sort and filter them as you please so that you can quickly identify potential opportunities in the market. You can also click on a watch list and start taking a look at what's currently going on, what's moving in the markets. So we have a sector watch list built for you so that you can see which sectors are currently strong, which sectors are weak. You can also drill down within each sector. So if you want to take a look at financial stocks, you can very quickly take a look at all the financial stocks and how they're performing. This is designed to give you new trading ideas every single day. You can also set up your own watch list if you need, so that you can create a list of stocks that you want to follow. The security analysis panel here in the middle is designed to simplify your research on the underlying stock. So a lot of times, I see clients that ask me, what do you use? Do you use the charts? Do you use fundamental analysis? And the answer is I don't use any of that. We simplify your research down to 2 very important indicators, and that's what the current trend of the stock is and the relative strength of the stock. Okay, so the 1 month and 6 month trend indicator tells you what the current short-term and long-term trends of the stock is. The technical score gives you a quantifiable way to determine relative strength so that you understand how strong a stock is compared to the overall market. You have things like support and resistance levels here at the bottom to let you know where that next support or resistance level is. And then we have things that are important for options traders, like where the next earnings, dividend, and price action is currently going on with the underlying stock. So I'll come back to this in 1 second because I do want to show you guys a few examples of how these 2 indicators simplify your research on the underlying stock. But I will come back to this 1 second to show you some examples of that. But I do want to just quickly show you. So once you have a view on the underlying stock, whether you're bullish or bearish, traditionally you might want to buy some calls if you're bullish or buy some puts if you're bearish. So how do you determine, what strategies to take? So as you can see here on the bottom, there's two buttons, I'm bullish and I'm bearish. And that's all you need, because when you click on I'm bullish, we'll present to you 3 bullish strategies on how to take advantage of a bullish move on Amazon. And the 3 strategies are designed to help progress you as a trader. So if you're only trading stocks today and you're brand new to options, then you're familiar with buying the stock. What we do is we compare that to a simple option strategy, which is buying a call. So for those of you that are brand new to options, this is your starting point here. When you're starting out with options and you're trying a simple strategy, is comparing buying the stock to buying the call. For those of you that are a bit more advanced in trading multi-leg strategies or complex strategies, you can look at the vertical here. And we put these 3 side by side so that you can learn and compare, so that you don't have to necessarily stick to one specific strategy. And the important piece about this is that you no longer have to first pick an expiration or strike price, because a lot of people don't know where to start with that. This already does a lot of that work for you. It tells you a starting point for both an expiration and strike price, so that you have something to start with and start learning and start exploring for those of you that are brand new. And for those of you that are currently trading, this is designed to save you time, because it provides a starting point. You don't have to go out and pick an expiration and strike price every single time. It already provides you with that starting point. So whether you're bullish or bearish, you're presented with 3 ideas. And for those of you that are looking to trade income strategies, so especially for those of you that currently hold on to some stock, maybe you've owned some stock for some time, you can generate some income on those stocks by selling a cover call or selling a put for the stocks that you want to own. So this also helps for those of you that don't have a directional strategy and you're really just looking to take advantage of this current holdings that you have, and you want to generate some income based on the stocks that you own. This will also present to you the ideal starting point for both a cover call and short put. But like I said, what I'm going to do is I'm going to come back to that. I want to spend a little bit of time showing you how this tool provides you with a directional view very quickly. So here on Amazon, you got a technical score of 10, which is telling me this has a strong relative strength. So it's on a score of 1 to 10. 10 are the strongest stocks in the market, 1 are the weakest stocks in the market. So generally speaking, if you're looking for bullish candidates, you want to look for bullish stocks in bullish sectors that are strong. So how do we define that? So what we do is we look at the sector watch list. And the sector watch list tells you the score of every single sector. So you know which sectors are strong and which sectors are weak. So it's very clear here to me that consumer discretionary, financials, and technology are the 3 strongest sectors, and utilities, real estate, and consumer staples are the weakest sectors. So if I'm looking for bullish stocks, I generally want to look for stocks in these 3 sectors. And if I'm looking for bearish stocks, I generally want to look for stocks in these 3 weak sectors. Okay, so, and what I can do is I can drill further into technology. So if I know technology is strong, or if I know financials are strong, I can look at that list. And again, it provides me the score of every single stock within that sector. So as I can see here, Principal Financial has got a score of 3. So I know these are weak stocks in the financial markets, not typically what I'm looking for. I want strong stocks in strong sectors. So here's Morgan Stanley. Here's an example. It's got a score of 8. As you can see, because it's green across the board, that means the 1 month and 6 month trend is bullish. This is telling me that not only is this a strong stock, the trends for both short and long term are bullish. Conversely, if I look at a different stock like AIG, slightly different story. Technical score of 3, telling me this is a weak stock, meaning this is a stock underperforming the market. So if you look at a chart, it's pretty clear this does not look anything like the S&P 500, which has just been on a tear higher. This stock has actually been trending lower throughout that whole process, and the 1 month and 6 month trends are bearish. So these 2 indicators alone are very powerful in helping you understand what the current trends of the stock is and where it might be headed. And the great thing about these 2 indicators is that it never changes. It's the exact same indicator. It uses the exact same methodology day in and day out. And that's how you gain consistency in your analysis. If one day you're using the charts to determine if you're bullish or bearish on a stock, the next day you're using fundamental analysis, the next day you're using the news, it's an inconsistent method to determine whether you're bullish or bearish on a stock. Using our method, you can gain some consistency so that regardless of what stock you type in, you can very quickly understand, is this a neutral stock that's turning bullish? Like, for example, UBS, this is a neutral stock, but the 1 month and 6 month trend is neutral. So, and if you zoom in here, I see that it just broke below a support level. So these are all the things that point to me, maybe this stock is headed lower. Conversely, if I look at Bank of New York Mellon, this is a neutral stock, but the 1 month and 6 month trend has turned bullish. So this might be a neutral stock that's starting to trend higher. These two indicators alone provide me with a lot of information that already encompasses all the other things such as fundamental and technical analysis, because it's using price action to derive this data. So once you have a directional view on an underlying stock, let's go back to, let's look at Goldman Sachs for a sec, for example. What it does is it allows you then to look at what are the trading strategies for trading this. And one of the things that this tool does is when you're looking at this option chain, it's really difficult to understand what is the, is this option cheap? Is this option expensive? It's really difficult to do that when you're just looking at this wall of numbers. It's really difficult to do that. So what we did is we created an options play score that lets you know, is this option cheap? Is it expensive? How's the risk reward here? And as you can see, I don't get very good risk rewards for buying a call or buying a call vertical. What this is actually telling me to do is that if I'm bullish on Goldman Sachs, this is not a good time to be using options to play this. The risk reward is actually not very good. So not only is this tool designed for those of you that are looking to trade options, it's not only is it designed to help you find ideas, make analysis, and ultimately trade them, but more importantly, it's designed to help make you prevent you from making bad trades. So $1,400 is a lot to pay for an at-the-money call that expires in just a little over a month. But you really can't tell that by just looking at an option chain. But as you can see, the green and red graph shows you there's a lot of red here, a lot of potential risk here with very little green or very little potential reward. That doesn't look very good, but you can't tell that by looking at a chain. But the options play score makes it abundantly obvious for you. So use the options play score to help you prevent you from making bad trades. But let's look at some other examples where maybe we can find you some good trades. Let's take a look at Coca-Cola. This is one of the weaker stocks, right? So technical score of 3 telling me this is a stock with weak relative strength. The 1 month and 6 month trend is bearish, so this is telling me that trends are bearish. And as you can see, it's been bearish for quite a few days. It went bearish on February 5th, and it's continued lower since then. So let's take a look at some bearish strategies here on Coca-Cola. So I can either short the stock, I can buy this put, or I can buy this thing called the put vertical. For those of you that have never traded a put vertical and you don't know what it is, that's okay. I'll show you how you can learn more about these types of strategies. But the most important piece that I want to show you guys is this PLL Simulator. So we all have our analysis, so we're looking at Coca-Cola. It's currently trading at $43.89. I see that there's some support down here at 42, 41. So what happens if I think the stock's going to go to $42? If I think the stock's going to go down to $42, as you can see, if I shorted the stock, I make a 4.28% return. If I bought this put, I make a 76% return. If I bought this put vertical, I make a 166% return. So if the stock moves down $1.89, I'm going to make a 166% return by trading this vertical. And that's why you get this blue box telling you that if you think the stock's going to go down to $42 on expiration date, which is April 20th, these 3 strategies will give you this type of return. So clearly this strategy here on the right gives you the highest return if you're correct. However, what if we're wrong? What if Coca-Cola goes higher? What if it goes back up to $45 or $46? So let's say it goes up to $46. Here, if I shorted the stock, I'd lose $212 or 4.5% return, a 4.5% loss. I'd lose $212. If I had bought this put, I lose $113. That's actually the cost of this put. And that's really one of the benefits of trading options is when you're buying an option, your risk is completely limited to what you've paid for the option. No matter what happens, you cannot risk more than what you've paid. So even if the stock goes to $100, you're only still going to lose $113. But look at here on the right. Even if I'm wrong, even the stock goes up to $46, I'm only losing $75 here. So if I'm right, I'm going to make more percentage gain on the vertical. And if I'm wrong, I'm actually risking the least amount of money when I trade this vertical. That's really why this vertical gives you the highest options play score. A lot of people ask us, what does the options play score do? It just simply tells you what the true risk reward of these strategies are and allows you to compare it side by side. So I know that this put gives me a worse risk reward than buying this put vertical. And that's why this put vertical gives you the green options play score with the check mark. Okay, so if you guys have all looked at this strategy and you say, hey, you know what, this looks pretty good. I agree with this analysis. I think it's going to go down to 42. If it does that, I make a pretty nice return on this vertical. But if I'm wrong, I'm okay risking $75. So this is a strategy I want to do. So one of the coolest things I want to show you is on the trade button. What this does is it provides you a view just to make sure you understand the risks that you take. So we have a strategy checklist. This makes sure that you understand the risks that you're taking before you place your trade. But especially for those of you that are currently trading options, you no longer have to manually fill out a ticket. Just hit the preview order button. I apologize. So on the preview order button, I forgot that you can't trade a multi-leg order electronically at Firstrade, but if you're placing a call or a put, when you hit the trade button, you can click on the preview order button and it pre-fills the ticket for you so that you don't have to, well, you can trade a spread actually, I apologize. So what this will do is actually pre-fill the ticket for you and it will provide you with all the details that we just talked about. So buy to open one contract of the Coca-Cola 44 put. It'll pre-fill everything for you, and you can just put in a limit order and go ahead and send this order off. So this is designed so that you don't make any mistakes when you're entering your plate and your order. So you can analyze a trade within options play, view it there, make sure you understand all your analysis. When you're ready for that, you just simply hit the preview order button and it pre-fills the ticket for you so that you don't have to enter these trades manually. So that just gives you a quick overview of how you can use this tool for those of you that have a directional view on an underlying stock. But now what I really want to do is spend a little bit of time talking about income strategies. Now, this is just I would say we're just touching on each of these subjects. I'm not going very deep into these subjects because we actually do additional webinars specifically on both of these trading strategies. So we'll talk about how to use the trading strategies for directional trades. We do specific webinars on that. We also do specific webinars just on the income tab. So make sure that you keep an eye out for those webinars, because if you want to trade cover calls specifically, we do have webinars just for that alone. So make sure you keep an eye out for that. So what I do want to cover real quick is for those of you that own stock and you want to generate some income based on that stock that you own, a great way to do that is selling cover calls. And for those of you that don't own a stock, but you want to own a stock, you can also consider taking a look at selling cash secured puts as an alternative to buying the stock outright at the current price, because that allows you to generate some income while potentially buying the stock at a lower price than the current price. So depending on whether you own shares of Coca-Cola, you can sell cover calls, or if you don't own shares of Coca-Cola, you can sell some puts to generate some income. So let's go through some examples. I'm going to pull up a watch list here. Let's take a look at some stocks. So let's pretend you own Microsoft and you want to sell some cover calls. Before you do that, one of the things that you want to do is first input your settings for cover calls. So by default, everyone's selected as short-term optimal, and that means what time frame or how far out do you typically sell your cover calls? Do you do a month or two, 2 to 3 months, or 3 to 6 months? You can choose the time frame that best suits your frequency of trading, and then you can also select your risk tolerance. Conservative means you're trying to minimize the risk of losing your your stock. Aggressive means you're trying to maximize the return of a cover call, or optimal, which is seeking a balance. So I myself, because I'm fairly active, I choose short-term, and I typically choose optimal for my risk tolerance. And you can set these independently for calls and puts. So you can maybe get really aggressive on the puts, but stay optimal on the calls. Whatever your preferences are, you can save this as default. And now for any stock that you enter, the cover call and short put that's presented to you is going to be driven off of your personal settings. So this is not us trying to tell you what's the optimal cover call to sell or what put to sell. This is all driven off of your own settings so that you can personalize and customize these strategies for you. Now, compare this to pulling up a chain every time you want to sell a cover call. You have to pull up the chain, you have to pick an expiration date, then you have to select a strike price, then you have to maybe calculate, how much return am I getting on this call? Is 90 cents a lot? Is 64 cents enough premium? There's a lot of manual work that's required to go out, find the right expiration, find the strike price, then calculate yields, then decide, is there enough premium in this for me to trade? Options Play does all of that work for you. Once you put in those settings, all you have to do is click on a stock, and it will instantly tell you what is the optimal cover call to sell or what is the optimal short put to sell if you are looking to generate some income that way. You can enter the number of shares that you own. So let's say you own 300 shares of Tesla. It will break down this trade to you in plain English. So for those of you that are brand new and you're new to cover calls, this is one of the first strategies that you might want to start with. It explains to you in plain English. So selling the March 29th, 357 and a half calls will generate $834 in premium, worth $834 in income for you. They produce a 13% annualized return, and there's a 79% chance this call will expire worthless. So if you own Tesla stock today, it pays 0 dividends. So you have no yield when you're holding on to this stock. This is the ideal type of stock to sell cover calls on because you're generating no yield by owning the stock. You only have capital appreciation, but you can generate some yield by selling cover calls. You can actually generate $834 in premium in the next 23 days by selling cover calls. And that's a yield of 13.23% on a stock that currently pays you 0 dividends. So you can increase your yield from 0% to 13% on a call, on a stock, by selling cover calls. So this is really why this is the most popular strategy with options traders, because most of you own some stock in your account. You want to find some ways to generate income. This is one of the ways you can do that. And this tool makes it abundantly easy for you because you never have to pull up a chain ever again. It simply just tells you what the ideal starting point is based on your personal preferences. So if you own IBM, let's say you own 200 shares of IBM, it'll tell you to sell the March 29th, 162.5 cover call. IBM currently pays a 3.88% dividend yield, which is pretty good. But this cover call generates a 7% yield, which brings your total yield from the dividend plus the cover call to almost 11%. So you're increasing your yield from 3.8% to about 11% by adding cover calls. Again, this is why this is one of the most popular strategies for income traders, or not one of the most popular. It is the most popular strategy amongst options traders, is generating yield against the stock that you own in your account. And this tool is designed to make it as easy as possible for you because you don't have to go out and search for the starting point, and it does all the calculations for you. So you can just go ahead and hit trade. And if you own this stock, you can just hit preview order, pre-fill the ticket for you, and you can go ahead and go off to trade this actual trade, okay? And again, for those of you that are shorting puts, same thing. If you have IBM stock and you don't want to buy it at 156, but you do want to own the stock, you can sell the March 29th 152.5 puts. This will generate $161 just to effectively say I want to buy the stock at 152.5. So that's the saying, I want to buy the stock about $3.50 cheaper than it is right now, or $4.50 cheaper than it is right now, and you're going to generate a 16.28% yield for doing so. So you're going to generate 1% of the underlying stock in the next 23 days just by selling this put. So this is where you can sell this put and potentially decrease the cost of buying this stock substantially by selling puts. So especially for those of you that are interested in dollar cost averaging into a stock, this is an interesting strategy to deploy so that you can buy the stock at a slightly lower price and still generate some income doing so. So with that, I just want to go back to the trading tab real quick. I just want to show you one more thing, and then what I'll do is I'll open this up for Q&A so that you guys can ask any questions you have regarding this platform. So one thing I do want to point out is regardless of whether you're bullish or bearish, we have a plain English tab here at the bottom. So for those of you that are brand new and you don't know what this vertical is, the plain English tab helps explain the strategy to you in plain English so you understand what you're trading before you place your trade. We really want to make sure that you understand what you're doing and understand your risks before you place a trade. That's the most important piece. However, for those of you that are a bit more advanced, and you want to trade some different options and you want to trade some different strategies, you can click on modify for any of these strategies. You can change the expiration date. You can change the strike price. So this will allow you to select any strategy. So for a lot of people, what they want to do is they want to compare buying one call strike to the next call strike. So if you're not sure if you want to buy the 155 or the 160 calls, you can then use the PLL Simulator and say, well, what happens if the stock goes up to 165? How do these two calls compare to each other? What happens if the stock goes lower? How do these calls compare to each other? And you can very quickly see which strategy kind of gives you the best return so that you know definitively which strike to buy or which expiration to buy, because you can put them side by side and use the PLL Simulator and see exactly what the expected return is. Also, if you click on modify, we have a strategy constructor. So if you want to trade more complex strategies, you want to use credit spreads, you want to do diagonals, these are all, straddles and strangles, these are all available to you through this type of tool so that you can set up all types of strategies using our strategy constructor. But that's really for those of you that are a bit more advanced or are looking for some of those more complex strategies. Click on the modify button. You can always change the expiration and strike prices or use our strategy constructor, which just quickly constructs some of these more complex strategies for you. So with that, I want to thank everyone for taking the time out this afternoon. What I want to do is I want to open this up for Q&A. So if you have any questions, feel free to put them into the chat window, and I'll spend as much time as I can trying to answer your questions. So Philip is asking, is the downside to cover calls that you may lose your stock if the price goes the wrong way? Your risk of, so let's do an actual example. So let's say you own IBM, and it's currently trading at 156.95. And this is telling you to sell the March 29th 162.5 cover calls. What that means is your risk is that you sell the stock at 162.5. So you can think of it as going the wrong way, but I don't really think of it as of the stock going higher as the wrong way, because if the stock goes higher, you're going to make money on the stock. So what you're effectively doing is you're locking in a potential sale at 162.5, which is higher than the current price. So generally speaking, people don't mind selling the stock at a higher price. So you're right, you do risk losing the stock, but it's at a higher price than the current price. So that's usually why it's a good thing, because that means you're making money on the underlying stock. And I do want to point out that if you don't want to lose the stock, you can always close out the option trade before expiration. So if you sell this March 29th 162.5 cover call, and on March 29th the stock's trading at 165 and you want to remain in the stock, then you can just buy back the call, and then you can remain in your long stock. So you don't have to sell your stock. Thanks, Dan. I hope you guys found this useful. Howard's asking, how do you calculate the probability score of whether your option strategy will end up making money by expiration date? Great question. So it's really simple, actually. So what we do is we take the implied volatility of the option and we create a probability distribution from that. And based on that, we can tell you what is the probability of the strike of the stock being above or below your break even. So for example, if we bought this call on IBM, the break-even price is 160 75. So that what we're basically saying is, based on the current volatility of the stock, what is the probability that in 45 days the stock's going to be above 160 and 160.75? And that's how we get the probability of 36.65, meaning there's a 36% chance that the stock will be above 160.75 and about a 64% chance that it'll be below that price. Does the tool give you a fair option price based on volatility? The fair option price is the current price. So I mean, if you have your own volatility assumptions, you can always plug that into a calculator. But the fair price is always the current price of the option. Wayne is asking, are there any spots in this app that shows implied volatility? Absolutely. So as you can see here at the bottom, there's a slider called "and volatility is." So you can actually also make volatility assumptions. So for those of you that are a bit more advanced, sorry, let me go back to this. So if I'm buying this call here, and I think the stock's going to go up to, let's say, 165, and I think it's going to do that on a certain date, whatever date that is, I can also say, well, the current implied volatility is 22.44. So I can also say, what happens if the stock implied volatility goes higher? How does that affect my option price? Or what if the implied volatility goes lower? How does that affect my option price? It's all around here available to you on the volatility. And for those of you that are looking for the Greeks, you can click on the, and just to show you guys, you click on the magnifying glass here for any one of these strategies. You can click on explain strategy in Greeks, and you will have the Greeks here as well. Ken's asking, I am used to seeing bid-ask prices for options. If you're selling a cover call, is it just a market order? No, not at all. You have the same bid-ask. So if you're looking at the income trade, right? So if we're telling you to sell the 162.5 cover call, when you hit the trade button, you'll see the bid-ask. So it's currently trading at 70 cents is the bid. Ask price is 92 cents. The midpoint's the 81 cents. So you still have the bid-ask, and you can enter this order however you want. So when you click on the preview order button, you still get this. This is still the previous order. Let me go back to the options wizard. You can still put in your own orders, whether you want to put in a limit price or a market price. All of that, you can choose what price you want to sell that trade at. So no, it is not just a market order. Great question. Howard's asking, is there a reason we chose April expiration date for your examples, just to simplify the concept, or due to its greatest liquidity? So the reason we chose April is, and this is, again, just a starting point for everyone. We're not saying April is the best place to trade per se. April just happens to, we're always going to pick an expiration date that's close to 45 days out. April 20th just happens to be the expiration that's 45 days out. The reason we choose 45 days out is because most traders that are looking to trade direction are looking about 1 to 2 months out. That's where most of the open interest is. That's where most of the volume is. So we default to an expiration that most people trade. So next month, if you come back and you do the same thing, you'll see the May 20th, because the May 20th will be the 45-day option going out. So again, this is not saying this is the best option for you, but this is a pretty good starting point for the broad market. For most people that are trading options, this is a good starting point. You can always click on modify. You can select a different expiration date if you want. You can choose a March one, a May one, a June one, a September one, whichever one you want, but we always start you off 45 days out. Okay, great question. Time decay. This is one of the things that a lot of people, have a tough time understanding. And, especially for those of you that have learned a little bit about the Greeks, and for those of you that are learning about the Greeks, they might be very intimidating. The PLL Simulator is a great way to learn about delta, theta, and vega, the three most important Greeks when you're trading options. So instead of thinking about delta, meaning how much money am I going to make if the stock moves up, you just simply use the price slider, because you can just tell me where you think the stock's going to go, and we will calculate the return of the option or the price of the option based on your delta. Theta, which is time decay, you can actually use this time slider, and it will actually show you how the value of your option changes with respect to time. So as you can see, as time goes by, if you're just buying a call, you're actually going to lose money every single day. As you can see, this number gets smaller and smaller as time goes on. What's interesting to note is that when you're trading a vertical, it actually gets higher and higher as you get closer to expiration, because in this strategy, time value is working against you, and in this strategy, time value is working in your favor. So that's really why trading this vertical is one of my favorite strategies, because you're limiting your risk, because here I'm risking 575, here I'm risking only 502, which means that if I'm correct, I make a higher return. At expiration, if I'm wrong, I risk less, because my risk is limited to what I've paid on the option. And as time decay goes on, right? If I'm correct on a trade, time decay actually works in my favor when I'm trading the vertical versus time decay working against me when I'm just long the call. So the PLL Simulator is really where you can use delta, theta, vega. But you don't have to think of those in those terms. You can simply think, I think the stock's going to go higher by this date, and it calculates the delta and theta for you based on the price of the option. What option price does the tool use to calculate the return? The bid-ask price or somewhere in the middle? Great question again. When you click on modify, so everything that that we're showing you here, the trade cost, the options play score, the returns, the max risk, max reward, break-even prices, these are all by default based on the bid-ask price. But you can also price this based on the mid. So if you can click on modify and you want to say, show me what the mid price looks like, then we'll recalculate everything for you based on the options mid price. So here now it went down from 505 to 485 based on the mid price. So as you can see on the natural price, it's 502. On the mid price, it's 485. And you can see how the analysis changed, whether you want to price it based on the natural price or the mid price. Great question, Ken. Looks like we have a couple of questions here coming in. Do you sometimes delay putting on the offsetting part of your vertical? Wayne, that is really a really advanced strategy for you to leg into a vertical. It certainly is a possibility, meaning if you're expecting a very large move very quickly, you can buy the first leg first, and once that move slowed down a little, then sell that upper leg. Absolutely. That obviously takes a lot more know-how. It takes a lot more. It's very sensitive to timing. You're increasing your commissions and transaction costs when you do that. So as long as you're aware of that, there can be some additional benefits to legging into your vertical, but it's really a very advanced strategy because you have to be very sensitive to your timing and you are increasing your transaction cost. So just to recap, if there's any last questions, please, you can ask them. Just to recap, this tool, for those of you that are brand new to options, I hope this tool inspires you to start looking at options and start seeing what the opportunities are, because you can type in a stock, whatever stock you're looking at, doesn't matter, type in your stock, get a quick read on kind of, is the stock in a bullish or bearish phase using the 1 month, 6 month trend and the technical score. And as you can see on Johnson & Johnson, it's quite bearish. Things are looking quite weak. It allows you to very quickly look at what are some possibilities. If I agree with this bearish strategy, how can I make some money? I can short the stock, I can buy a put, I can buy this put vertical, and use the PLL Simulator to learn about these strategies and see how they perform. And if you're brand new, maybe just follow along. You don't have to place a real trade when you're starting out, okay? So I hope for those of you that are brand new, this tool kind of inspires you to start taking a look at maybe selling some cover calls against the stock that you own in your account, generate some income. And for those of you that are already trading options, this tool is designed to save you so much time, because I know how much time I spent as a trader going through the chains, finding expirations, finding strike prices. A lot of times the first time you pick, you don't pick the right strike, so you have to go back. There's a lot of back and forth. This tool makes it so easy for you to set up different strike prices, different I can quickly set up 3 put strategies side by side, change the expirations, change the strike prices, and see how they perform using the PLL Simulator. This is designed to save you guys time so that you're not spending all that time doing tedious work through the chains, and you can really spend the time analyzing trades, making sure you understand your risks before you place your trade, and then when you're ready, just hit the trade button, preview order, which fills out the ticket for you so that you don't have to manually fill out your ticket every time. This will save you a lot of time with your research and your analysis. So I hope you guys have found this video useful, and it is recorded. Looks like we have one other question here. You started your demo using Apple as an example. Can you go back to that stock? Absolutely. So Apple, as you can see here, it's a relatively strong stock. It's got a 1 month and 6 month trends that's bullish, which is, short and long-term trends are bullish. And, this was a trade idea yesterday because as you can see, we had some oversold indicators that just, crossed its buy signal. So everything kind of lines up, at least for me, looking at some bullish strategies on Apple. So what it does is it shows me 3 starting points. I can buy the stock for $17,000. I can buy this call for $660, or I can buy this call vertical for $551. Let's just take a look at Apple stock here, right? It's kind of hit this high here around 175, 190 area. It hasn't really made much leeway higher since then. So, if you are the type of person who thinks that, hey, maybe Apple's ready for a breakout higher, and you think it's going to go to 185, 190, then this is the type of strategy that you might want to take a look at. So as you can see, if you think the stock's going to go to 190, here you make a 7.5% return buying the stock, you make 127% return buying the call. If you bought this call spread, you make 172% return. So if you are expecting a breakout, you're expecting the stock to move significantly higher, these are the types of strategies you want to look at. However, I want to point out, Apple hasn't really made it much higher to 175, 179. So what happens if it only goes up to 180? So this is a very realistic example, right? Maybe it doesn't go much higher. Maybe it just kind of stays where it is. So as you can see, if I bought the stock, I make a 2% return. If I bought this call, I actually lose 24% return. If I bought this vertical, I lose $51 or a 9% return. So this shows you that if you think that the stock's going to move up just a little bit by about $4 or $5, then the option market is not for you, or at least these option strategies is not for you. Okay, so this tool is not only designed to help you find the right trades, but more importantly, prevent you from making bad ones. Because you could have said, I think Apple's going to go higher, let me buy a call, but not realize that if the stock moved up to 180 by expiration, you're actually still going to lose money on this call. That's something that we see a lot from traders, where they buy a call, the stock goes in the direction they want, but they still end up losing money. And sometimes we don't know why. And this tool is designed to quickly tell you exactly how this strategy will make money or how it will lose money, so that you can know these things before you get into a trade and not after. Okay, so great question, Howard. I hope that you guys found that useful. And I hope you guys use this tool. It's available to you free of charge. Like I said, you can find it either on the option chain. There's a button here called Options Wizard. So if you're looking at an option chain, click on the Options Wizard, which will launch it, or you can always find it under the Options Wizard button here on the upper right, on the right-hand side under options trading. So again, I want to thank everyone for taking the time out this afternoon. I hope you guys have found this useful. And feel free, if you have any questions, send them to Firstrade. They'll forward them on to me, and we'll be back doing some webinars in the future. The next one I think we'll do some ones on income trading, because it's the most popular strategy. A lot of you have some stocks and you want to generate some income. So we'll do one on best practices on generating income using covered calls. So we'll do that in a couple of weeks, and I hope to see all of you there.